Let's start with a check on the crude prices, which have gained on the back of demand expectations from Asia, but the slow pace of global economic recovery caps gains. The U.S. manufacturing data expanded less than market estimation. This coming on the back of disappointing Chinese PMI data has dented hopes of a global recovery at a faster pace. The closure of Exxon's leaking pipeline also put pressure on the crude prices, with the NYMEX coming off its 6-week highs. On your screens, below $97 is how NYMEX is trading, but there has been some strength which has come back in Brent crude prices. Meanwhile, the gold prices gained but remain flat despite disappointing U.S. manufacturing data. Investors await the U.S. payrolls data out on this Friday to determine the state of the U.S. recovery. On your screens, more than $2 or nearly $2 of a decline coming in for gold. It's trading below $1,600 per ounce. Let's get in then. Chirag Seth, VP, Latin Manharlal Commodities. Also joining us is Vijay Bamwani, who's author and CEO of VSPLindia.com. Chirag, hi, let's start with you first. And what's your sense coming in for the crude prices now? I mean, after the kind of gains that we have seen, just about holding 96, 97, how would you want to trade that?
Yeah, we've been fairly bullish on crude for quite some time, and have been regularly, recommending buy at around $94, $95 kind of that range. We believe that crude oil prices has still got about $1.5 to $2 kind of upside. I think the fair price would be around 98, 98 and a half. Keeping that in view, we would be buyer into crude oil above 5,300. Once the MCX contracts closes above 5,300, it would provide a fairly decent opportunity for somebody to buy and look for at least 70 to 80 rupees on the upside in the short term, and maybe 100, 125 rupees over the next couple of trading sessions.
Vijay, how would you look at the natural gas prices? Last couple of days or sessions have been slightly on the weaker side, but natural gas is 20% up in 2013.
Manisha, yesterday I talked about natural gas being weak if it traded consistently below the 216 level and possibly going to 211.12, where it becomes a buy. I would maintain my view. The range is still 211 to 12 on the downside and 220 on the upside. So every time it goes to 211 or 12, natural gas is a buy as far as I'm concerned. And close to the 220 mark, it's a higher risk short, because the outlook at this point in time is buy on dips. So if you're shorting at 220, you needn't wait more than 2.5 rupees to cover your shorts. And buying the dips is a whole lot more profitable as far as the risk-reward ratio is concerned, provided it comes to 211.12.
All right, so very strong gains coming in on your screen there for natural gas, whether it's 3 months, 6 months, 52 weeks, it clearly has been a gainer in the energy pack. Chirag, how would you look at the precious metal space? Because that is trading negative for 2013 between gold and silver. Which one are you picking up?
I think we are bearish on both gold and silver at this point, purely from a short-term perspective, at least till this Friday. In that sense, if you look at what has happened, despite the fact that there have been whole Cyprus news, and despite the fact that because of that, euro has been still able to hold on, I think we are not seeing that kind of gains coming into gold and silver that we should have ideally seen. So we believe that, maybe till Friday, till the time the non-farm payrolls data does not give a clear indication, one should use any kind of recovery that we see in both these precious metals, go ahead and short. So anywhere around 29,850 or 890 around in a kind of gold should be used as a level to go ahead and short, or at around 52,550, 50,580 in silver should be used to build short positions at this moment.
Vijay, we have been talking about 52,500 kind of level in silver, and that really has come into the market now. Are you looking at further declines?
Quite possible, Manisha, because the bullion is not really showing any kind of exuberance or any proactive buying at lower levels. The safe haven buying at this point in time seems to be deferred. Having said that, I think 52,000 levels would provide a delivery-based investor with a longer-term perspective to start picking up, maybe allocate 10% more of the amount that you've allocated for silver alone. At 52,000 plus VAT, I think I would feel comfortable buying silver. Having said that, I think a 10 to 15% decline at any given point in time, even from 52,000 levels, should be a possibility that an investor needs to keep in mind, and therefore calibrate or space out your purchases accordingly in the physical segment. Leverage buying both in gold and silver is out, because the cost of carry would mean that you're working for the financier, and going long is basically detrimental. You won't even recover your cost of carry at this point in time.
Vijay, also what's your sense coming in for the base metal prices now? Because aluminum is trading at a 5-month lows on LME, nearly 4-year lows in Shanghai. Same is the case with copper. Multi-month lows coming in on LME and Shanghai. And the LME inventories, of course, are at decade highs. In that scenario, how would you want to trade both these metals?
Manisha, it's been approximately 2.5 months since I've been talking about sitting on the fence as far as industrial metals are concerned, and this is the reason why. The charts were indicating that there is some kind of a concerted deleveraging in the financial markets as far as industrial metals were concerned. And as long as this deleveraging is underway, any kind of an upthrust is getting sold into. Stronger hands are unwinding long positions and therefore capping the gains. If you check the daily and the weekly charts, there is a consistent and very clear demarcated lower tops and lower bottoms formation since at least 2.5 months. Unless we see a breakout in the sense of a previous swing high being overcome with very high volumes, at least 30-35% of the last fortnight's average, with at least 30-35% increase in open interest, I would say that that's a dead cat bounce itself. And you needn't buy dead cat bounces because they terminate abruptly without any kind of a warning. So I would want to see at least one swing high, whether it's aluminium, whether it's copper, whether it's lead, zinc or nickel, before I would go out and commit money on the long side again. Having said that, I think when the recovery comes at this point in time, as we speak, I think aluminium is better poised than compared to the other ferrous or non-ferrous metals.
Fair point. Chirag, what's your sense? Which one are you picking up in the base metal space, given the fact that apart from all the other fundamentals, the manufacturing numbers also have come on the weaker side?
Yeah, I think the only one which we are positive at this moment is most probably lead at this moment. There are some very strong news coming out of China with regards to shift towards the, battery-based, either bikes or motorbikes for that matter. And that is likely to give some sort of, fillip to lead prices. So we would be more comfortable into buying, lead at around somewhere around 113.50 kind of those kind of levels, and look for target around 114.50, 115 in the medium term. Having said that, there is also nickel which looks fairly decent on the downside. So anywhere around 880 or 875 where nickel we would look at buying nickel, because stainless steel, again there has been some pickup in production for stainless steel, especially out of China. I think that is likely to be some sort of supportive for nickel prices in the medium term.